really for the child's education, and saying they don't want that to be in the kid's name. They don't want to be funding the world's best gap year at age 18 when legally they get access to all the assets, because they are worried about what that's going to mean for someone who's just become an adult to be handed unfettered access to a large investment account. Those decisions are something we really need to have together in the initial discussion.
Welcome to the US UK Tax Talk podcast. Today I'm joined by Patrick Mulhern, a partner at Tanager Wealth Management, who specialise in US UK financial planning and wealth management. Patrick was actually the first external guest I had on this show over 4 years ago, and so I'm really grateful that he's agreed to come back on, and I'm only sorry to him that it's taken so long to do so. Today we discuss the really important concept of how to invest for children where there are Americans involved, because as like so much in this US-UK space, Americans just provide that extra complexity. And so I'm really grateful for Patrick to come on and share his expertise in this area. We hope you enjoy the episode. Patrick, good morning. How are you today?
I'm doing quite well, thanks. It's great to be back. It's been a little while.
It has been a little while. I trailed at the beginning of this episode that it's been over 4 years since you came on this show. You were the podcast's first external guest back in 2021, back in the nascent days of this series where no one really knew what was going on. And you were very generous to come on with your colleague, Chris, and be guinea pigs on this test case that we were running of trying to do a podcast for Collier Bristow. So I thank you very much. I'm sorry it's taken me so long to have you back. It's a bit different, the setup now, but hopefully it's going to be the exact same sort of, red hot content it's always been.
Do my best on that. And I'm not just a participant here, I'm a subscriber. So I've been seeing everything you've been doing. You've been going from strength to strength for years here. So thanks for having me back.
Very, very kind of you. Thank you. As I mentioned at the beginning of this episode, what we're going to be talking about today is US UK wealth management. That is a concept, a topic that has been done before on this episode. But what you and I had been talking about offline that has resulted, I think, in the triumph and comeback of Patrick Mulhern on this podcast is where we've never looked to. And one of the thorniest places that often arises in wealth management is thinking about where there are American minors involved, or where the US UK space has to delve into what solutions are available for minor children. Because if we thought that the US UK financial planning wealth management space is complicated enough, once we start to introduce children, you've always told me, it really starts to throw up quite a few different complexities. And so I'd love the opportunity to sit with you and to have you explain where these issues arise, what are the sorts of solutions that you talk to clients about, and how this otherwise amorphous, complex blob of difficulty can be cut through by someone with your expertise.
That's it's kind to set it up that way, but I think there's a lot to talk to it about here, because you're right. Fundamentally, if you think it's difficult for someone who is legally able to make their own decisions to make the right decisions, it gets even more complicated when you're dealing with people who need to have a guardian or a parent make all the decisions for them. So it's a tough space, and both jurisdictions have set up many programs that are available to children, but most of them are going to be interpreted slightly differently in the other jurisdiction. So in fact, probably all of them are, as we'll probably get into today.
That's exactly where we're going to go over the course of this episode. So what I want to invite you to do, if it's okay, because it's been a little bit of time since we actually took a step back and thought about wealth management in its broader sense, we'll remind ourselves, or remind our listeners, why this is a topic that is worth discussing more broadly, why it is that Americans living in the UK, to take the common test case, why they have to think particularly about the products they use, the investments that they invest in, and then we'll use that fundamental base to apply it towards the additional complexities that then arise for children. So if it's not too broad a question, or if it's not too slightly a pointed question to ask you, Patrick, what is the point of US UK wealth management, given this is what you do for a living? Patrick, what is the point in US UK wealth management, and why do Americans have to think about it so carefully?
Well, hopefully some of your listeners may have already encountered some of these basic points, but to start from the very first step on this road, obviously some of the key things to know is once you are a US person, citizen, green card holder, whatever, who is resident here in the UK, your life gets a lot more complicated because there is going to be citizenship-based taxation rules. You are going to have to think about how to keep the IRS happy and keep the HMRC happy at the same time. And while I'm not a tax advisor and don't have the regulatory background to give specific tax advice. Certainly, good wealth management that's based on proper investment structuring, financial planning that gets to know you and your family yourself, all of the ancillary services that come with it, from transferring funds and everything else, that is all specialized if you're dealing with someone who's a dual taxpayer, because the normal off-the-shelf solution is never going to be quite right. And if something isn't quite right, as you have probably talked about to death on this podcast, the usual thing is that small germ of a problem becomes a very, very big tax problem when it gets to reporting it in one jurisdiction or the other.
The problem, as I've always sort of tried to explain to clients at its most fundamental basis, is if we take the simplest thing that you can be invested in, which let's say is cash, or it's a chattel, it's a personal asset. There's not a lot that can go wrong with that particular item. Let's take the cash in this scenario. Anytime you move away from a static inert object like cash sort of tends to be, and you move into a particular asset, there are particular tax rules about how that asset is taxed, or rather the fruits of the profits of that asset, the dividends, the income, the capital gains, the sale proceeds, how those are all taxed. And the UK has a particular set of rules that say how given assets are taxed, and they want to incentivize customers, clients, individuals to invest in certain things, either because from a public policy perspective, they want the UK population to invest in gilts because it provides greater cash flow for the government, or they want you to invest in ISAs because it encourages long-term investment planning, etc. And so they are prepared to give incentives, deductions, reliefs, exemptions on particular products. The IRS is doing the same thing with its own tax code for its own domestic US reasons. There is no assumption that just because HMRC offers one relief in one area, that the IRS is going to offer the exact same relief. And in that crossover is where you end up with people in your practice, Patrick, because you know where the crossovers are or where the distance between those two areas are, because you want to have Americans avoid investing in certain UK products or have UK residents avoiding in certain US products because you only end up with the tax relief in one country. And if you're not getting the tax relief in both countries, it undermines significantly the value of doing it. That's the way I've always understood it, if that's not wrong.
That's a great way to phrase it. In many ways, what seems so appealing is whenever you find that perfect strategy or product or account structure that is going to be tax-free, because who doesn't like a tax-free solution, right? It's perfect. But tax-free is more often than not a problem, because if it's only tax-free in one jurisdiction, all you've really done is get rid of any tax credits that could have been used to offray other costs. And instead, you're just left with a pure exposure to being taxed in the jurisdiction that didn't think about that structure. Yeah. And it's probably going to be bad.
If it was easy, if it was, well, obviously every American should open one of these accounts, or every UK resident that has US assets should do this with their accounts, there wouldn't be a specific industry that says, let us help you and work with you to craft a tailored solution. You wouldn't have this issue of Americans constantly struggling with the way in which they report their affairs to the IRS and to HMRC. Everyone would just do this thing. And so I've always understood from you, and one of the complexities of this area, and even more so when maybe we come to talk about minor children, is there is no one solution that suits everyone. It is really a case of crafting a particular plan for that particular family, for that particular individual, because what family A needs as their priorities might be different from what family B needs. And so making those different products, those different accounts, those different investments work to produce the right goal to meet those clients' objectives is going to depend on every different scenario.
That's right. I mean, it's amazing how quickly it gets complicated. It seems like on paper, people that are almost exactly the same would end up in the same situation, but little tweaks. Which of the adults in the relationship are British and which are American? Who's the higher tax rate payer? Are there trusts involved from people back in the US? Is there an inheritance expected in 10 years? Is there a retirement coming up sooner? Is there an illness? Tiny tweaks just can start building and building and building and lead to really, really different optimal advice. So it has to be customized. It has to be tailored.
What I actually want to sort of dovetail this episode with, and I want to maybe use the frame of the minor child to explore a little bit further, is something that I said to you offline a couple of weeks ago, which is a lot of time when I, as a non-financial advisor, think about this issue, I'm thinking about the products. So I'm thinking about, for example, why an American shouldn't invest in a UK collective investment, or why a PFIC, and why a UK person shouldn't invest in a US mutual fund. I'm kind of thinking about it at the product level, at the investment level. But actually, I suspect where we're going to go, if I've understood anything about your job, when thinking about minors, is it is as much often about the account that you pick, or the type of vessel, the type of bucket into which all of those investments sit, because it is not just the investment that has a particular characterization, but, to spoil where we're going slightly, things like junior ISAs or UTMAs or 529 plans, these are all specific account wrappers that then go around the actual investments. And so you kind of need to make both the account and the investment work in the compliant and tax efficient way, because if either of them fall foul of one country or the other's tax code, you're ending up in a problem. So you've actually got two different things you need to watch out for.
Yeah, and it's probably true for adults as well. You still have to think about, should I be saving into pensions or ISAs, or set up a trust, or offshore or onshore? Those questions still exist at the account structure level. But I think one of the other things is that the numbers involved with children, not at all times, but tend to be smaller. We tend to be thinking about the junior ISA limits at $9,000 a year. We tend to be thinking about gifts from grandparents. Just from my experience, the default tends to be, this is simple. This isn't very difficult. This is a small part of my financial plan. Sure, I've got my other bits invested in my business or my trusts and pensions, but now I just want to be putting something aside for my children. Maybe they were just born. That's exactly right. You want to be reminding people, no, actually, this is still complicated. This still really needs to be thought through, because all those same issues, the account structure and the underlying investments, still apply here. And we still need to be thinking about those from first principles.
Yeah. And I think probably before you even get into the discussion, which we're about to come on to, about, what are the specific solutions that might exist, you even have to say, well, in your scenario, maybe this is a relatively incidental part of my total wealth that I'm looking to set aside for my children. Well, conceptually, how is it being set aside for your children? Are you saying you would ideally like to ring fence and set aside this amount of money? It is now, in a perfect world, your child's money. It's taxed in a perfect world at their marginal rate of tax. Or are you just saying, well, I have X pounds to my name or X dollars to my name. I'd like to notionally set to one side and ring fence some money that I think I might like to put towards my children, but it's still my money, or it's money that my parents want to set aside for my child, but they're content to give it to me in the first instance because I'm going to have to spend it. Or are we actually talking about handing over the money to the children, which is where, in that scenario, some of the additional complexity arises because, for example, we are dealing with minors, and minors opening accounts becomes a lot more complicated.
That's right. So, let me talk about that, some specifics of what I often see. So usually this discussion is going to come up in terms of ownership and do you want to ring fence something or do you want to gift something right away? More often than not, the starting foray here is going to be when somebody comes to us to start thinking about getting ready for big costs, usually around university years for children that are relatively freshly arrived. And we have that conversation in the financial planning context. We'll say, this is a major expense, a major liability that's coming up in your future. We can start to put some numbers around it using actuarial tables and what we expect to be the inflation rate on educational costs and say, this is likely to be your future liability. Okay, so we want to make sure, to the extent we can keep close to that, you've paid for this over time, whether that's going to be periodic saving, putting away $10,000 a year, or a big lump sum now from your existing assets that just is going to be ring fenced. And I think clients conceptually get that. They say, okay, if I want to send someone, new child, to a university here in the UK, maybe thinking 3 years of an English university, top up fees, we can start to do some discounting and say what we're going to be putting aside for them. And they think they're done, but then there is the question of saying, now, do we want to look at putting in place a 529 plan? Do we want to explore having the assets put into a junior ISA so the currency is the same as what they might be spending in an English university, or into a UTMA in their own name? There are streaks to that. There's going to be some advantages to making that gift go down a generation depending on the circumstances. But surprisingly often, the right thing for the client, which we always give them the choice to talk through and find the right fit for them and their family, is to say what you were saying earlier, that actually they're perfectly happy keeping control over these assets themselves in their own name, but having it set up with a different account and a different risk tolerance and everything set up really for the child's education, and saying they don't want that to be in the kid's name. They don't want to be funding the world's best gap year at age 18 when legally they get access to all the assets because they are worried about what that's going to mean for someone who's just become an adult to be handed unfettered access to a large investment account. So those decisions are something we really need to have together in the initial discussion.
Something that I increasingly talk to clients about with my kind of tax hat on is this idea that tax efficiency is a binary option. You either go for the option that's most tax efficient or you don't. Whereas actually it's an analog spectrum, it's a scale. Because the comparison I always give to clients is imagine you're sitting in your car and you're setting your sat nav up. And let's say your sat nav says it's going to take you an hour to drive from point A to point B, and it's going to be on the motorway. And you're like, fine, okay, that's an option. And they go, or I can offer you the quickest version, which is going to save you 5 minutes, but it's going to go through all the various back roads, and it's going to be a much more complicated drive. If you have a sat nav that merely says, give me the quickest route, it will only show you the really complicated route. Of course, in practice, most people are just going to say, well, just give me the easy route. I don't like the fact that it costs me an extra 5 minutes is actually not there. Give me the most convenient route, not the fastest route. Pulling that across into this kind of space, what I often talk to clients about from an estate planning perspective, from a tax planning perspective, but I think it applies equally in the financial planning world, is if I say to clients, or if you say to clients, you can set up this account for your child, you can put the money into it, and so from purely a tax efficiency perspective, it's going to achieve 98% of your total efficiency you could possibly want for your child. Let's say it's a perfect solution. But there are various risks involved, double taxation risks, money passing to your child at the age of 18, non-tax risks. Or we can get you the same efficiency, but maybe not quite as much. Maybe it's only 90% efficient, but it's a lot easier if you just hold the money in your own name. Now, is that 8% differential worth it in your mind? Are you prepared to go through all the administrative hoops, the extra form filling, the riskless double taxation, all of that extra aggravation for the benefit of that additional 8%. And very frequently, when you kind of frame it in those terms, estate planning, tax planning, financial planning, clients often go, just give me the easy life, unless you tell me that the compounding over 20 years for a minor is going to be relevant, which is why we're talking about it. I don't care about losing that 8% differential or something. I try and sort of offer it in those terms because I think sometimes people lose sight of the wood for the trees of what efficiency actually means.
I think you're exactly right. And a good practitioner would always sit down and explain it and then give as many options as possible that are digestible, and then step back and say, well, this is going to be the strengths and weaknesses of each. So which one it fits best for what you're trying to achieve here? And you're going to be amazed how many times it's going to be different based on the appetite of the person, not based on the fact pattern.
Yeah. Let's move forward and imagine we have minor child with, until such time as you tell me it makes a material difference, let's have, either two American parents or an American parent or a UK citizen parent, let's say. At a fundamental level, I appreciate I'm teaching you, Patrick, here, or I'm asking you to suck eggs, to use the expression. What is the fundamental problem with a minor child owning money in a bank account in their own name? Why is it complicated?
Sure. So, the basic things to remember here are going to be that the minor child doesn't have actually any legal ability to direct this money or to do any real massive decision-making with it. It's in their name, but there has to be a custodian that's over it. So if that's a bank account, it's still going to be cash in their name, but locked away for the future, possibly usable for their own expenses if there's going to be educational cost or something, but not something that could easily be changed around, moved to a different structure or anything like that. It's cash in their name that needs to be protected till they're 18. And then let's just keep seeing how many twists and permutations you want to do, because it's rarely cash that's the issue. There's going to be some reporting if there's enough in there. There's going to be some small amounts of income coming off from the interest payments. Relatively easy to handle that. But okay, well, what if you have someone like, I don't know, my kids, right? I'm the weird American that's come in from abroad and messed up an otherwise very nice, very calm British family where there's British only cousins, and then there's these dual citizen children that come on our wing of the family. And the grandparents want to be fair. They want to make sure that everything's being divided up equally. So if they're helping out and contributing somewhat to a junior ISA for the cousins in London who are British only, and now we have two new ones. Mine aren't so new anymore, but when they first arrived, people saying, I want to make sure that we've been equal, that we give everything here. And the junior ISA is tax-free forever. Why would we not choose that route? So you frequently find that there are family members who want to start contributing to British accounts because they've been doing that already for the family. And you have to put up your hand and say, actually, can we be sort of complicated here and say it's a very kind gift, but we want to be careful that we're not getting into the wrong structure? Because what happens there with the junior ISA? What happens when you have the maybe person who never took advice before that happened? They moved here. I moved here when my wife was in her third trimester with our second kid. So it was only a couple of weeks after we got here that we had our son. And you have other things going on. You're not necessarily taking advice for the first time. So you end up with the junior ISA, maybe with a few £1,000s inside of it. And now you have an investment account that can't be changed, or the money can't be withdrawn or revoked until the child's 18. And that is tricky because, yes, it's going to be tax-free in the UK. So income, dividends, any realized capital gains will all be totally fine, tax-free. But this is a US citizen who owns the junior ISA. And that activity, taxable activity, has to be reported on their US tax return.
Just to be clear, because going back to the thing we said at the beginning, an ISA is a specific product with regulatory tax efficiency baked into it by the UK government that has decided it's a good idea for people to save outside of, say, a pension arrangement, and therefore we want to encourage people to put money away, and if they use an ISA, we, the UK government, will provide them with a specific tax advantage, i.e. the tax-free roll-up of income and gains. That's a UK-specific thing on a UK-specific product. The US, frankly, as far as they're concerned, this is a bank account. You are welcome to take whatever UK tax relief you want, but we in America treat this as a bank account and we are going to tax it accordingly.
Thank you for slowing that down. If it's first principles there, absolutely. UK offers tax advantages. The IRS looks at the ISA and says, oh, that's nice. You've decided to open an individual savings account in Britain. Just like everything else, we want to be taxing you on your worldwide investments, so we want to know about that one. And so you x-ray inside of it and you say, or rather the IRS x-rays inside and says, well, what happened inside of here? Is there any income that's being produced in dividends? Well, let's make sure they're taxed. And then the authority issue that comes up, and I know you've talked about this a lot on your podcast, is the capital gains that are going to be realized when you sell an investment inside of that junior ISA are likely to be taxed at much, much higher rates, what they call PFIC tax rates, because almost certainly the investments inside of a standard junior ISA are going to be some form of fund, mutual fund or ETF or tracker fund. And in that situation, you are facing much more onerous, much more regular annual costs associated with maintaining that investment. The default is going to be some very happy new parents that are pleased they've been saving for their kids come to us and find out that they are not only in a problem because they've invested in all these bad investments, not only do they have to face back taxes on all the things they forgot to report because they didn't know, but the punchline at the very end is that then you can't even get out of the junior ISA because once set up, it's locked into that structure until the child's 18. So there are things we can do. We can look at finding ways to minimize the costs and bring down the tax penalties. But no one, I think, would say that that's probably the optimal solution here, to wander into that without thought beforehand.
Just to go back and double down, I think, on one of the points you made, the issue that can arise particularly, you've said, is from an American perspective, is the PFIC issue, i.e. that you're using collective investments that are considered passive foreign investment companies from the American's perspective, and so PFICs are taxed at a more punitive tax rate, the inverse of a UK person investing in a US mutual fund, most US mutual funds, for example. From my perspective, my amateur brain, the reason why that's more impactful or more likely to occur with a junior ISA type scenario is because you are investing for a very long period of time. Long period of time relative to what you might do for yourself. Let's say you're investing for 20 years. You could, and maybe Patrick, someone in your field with the expertise might stock pick and might say, well, I'm going to invest in these individual stock in my ISA. Those aren't then PFICs, and that's probably a bit simpler. But most people are not going to invest in direct stock and manage that portfolio of direct stock for 20 years. You're probably much more likely to invest in something lower risk, spreading your risk, diversifying, going for something like a tracker fund, an index fund, or something like that, which is then much, much more likely to be a PFIC. And so, a regular non-American financial advisor in the UK is probably going to be recommending, because of the long timescale, because of the desire not to play a high-risk strategy on an amateur level with a child's money, you're more likely to end up in this scenario than, for example, someone who uses a E-Trade platform who's having a bit of a flutter themselves and doesn't mind investing in direct stock because they don't mind stock picking for themselves, less likely are they probably to be going to do that with their child's money.
Absolutely. And then that also gets to the point of, should you be doing this in the first place? If it's high risk and a bit of a flutter and all these things, probably isn't the right thing to be taking your child's money and having it be very, very high risk when you otherwise wouldn't want it to be. So you're trying to avoid that because it's certainly you're chasing an investment strategy that's based off of fixing a tax problem instead of anything even close to the right thing for the person and the objectives.
So the other part to the UK planning and the US complexities for it, before we kind of invert it and think about the US planning and the UK complexities with it, that I know you and I had discussed previously, is also this concept of how the American tax code sometimes views the relationship between the custodian and the underlying child that being invested for. And this is going to come back when we're looking about it the other way around as well with US accounts. It's very, very easy in a UK context to say, I am holding this money for my child. There may be a time when I, as a UK parent, am taxed at my rates on the income. That's a relatively straightforward thing to manage. We refer to that as a bare trust. There's the legal terminology for it. It is just a nominee arrangement. A junior ISA is in effect that sort of nominee arrangement. But from an American perspective, just to sort of take this to where this can often go, and you and I have shared clients where this is the case, the Americans look at that arrangement and go, this isn't just a simple nominee arrangement. This is maybe a parent who has created a trust, and that trust is a foreign trust to the US, and it is going to encounter various tax and reporting consequences. Far in excess of the bureaucratic complexity that the parent thought they were going to be putting in place when they put the planning in place. Because the Americans, exactly as you said, the Americans want to know about absolutely everything that is going on overseas. They want to know about what's in all of your foreign bank accounts. They want to know about all of your foreign trusts that you're a beneficiary of. And that means having to disclose in really, really high levels of detail about all of these arrangements that from a UK perspective, you think of as banal.
There's so many ways that it happened. And again, you and I have shared this, that you have to go into the real detail of who was doing the gift and where the source of the funds came from, not from an anti-money laundering perspective, which we all think about, but in terms of what, therefore, the state of the tax is going to be off the differing parts of income and dividends and capital gains. That different things will be attributed to different people based on who made the original contribution to capital. And that's certainly where you would get together a whole team of people. There'd be accountants and lawyers and wealth managers here coming together for that. But you're right. What seems like something you just get off the rack from a quick junior ISA online quickly metastasizes into something much, much more difficult.
Yeah. I want to now flip the script, and I want to think about US investment management and the UK complexities, because I think my experience is this is where we end up in the greatest number of stumbling blocks, because we are entering a scenario where either or any of parents come to the UK with existing planning in place for their children because they moved while their children are already alive. Parents have moved to the UK from the US, but grandparents are still in the US. And so from their frame of reference, exactly as you said previously, they're thinking about what they can do to set money aside for their grandchildren. So they are thinking about it in a US frame of reference. There are a number of ways in which Americans thinking about their wealth management are coded into thinking about wealth management and the selection of products, etc., on a US basis. And so I imagine a very large proportion of your time is spent warning of the UK risk of US investments as much as, if not less, more than the US risk of UK investments. Or am I misguided and actually you do it both ways? Whichever way you turn, people cock it up.
Maybe I'm more of an optimist, I guess. I think that the US offers more solutions. There's certainly pitfalls. There's certainly issues. And you and I can get into the bare trust implications of a lot of this. Often we're going to end up with just cash, the first place we started in this whole discussion, and then we're trying to do something with it. My perspective, from my view here, having done this a lot, it tends to be the IRS's interpretation of UK account structures that causes the most headache. And that with good planning, a lot of US-based solutions are very much viable with the HMRC. They just need to be set up right and thought through from the beginning. Because to go back, I know we've moved to talk about US-based platforms, but there's a reason that we got hung up on junior ISAs. They're a very common pitfall, and the IRS does not like them. One thing we didn't talk about, and maybe I'll just quickly highlight, because it doesn't work very well often, is going to be things like junior pensions, which do benefit from much more protection under the terms of the tax treaty, because there are sections about pensions. So it is possible to be putting money aside from a very, very young age for a child who's resident in the UK inside of a pension structure, with the hope that that money will grow and grow and grow over 50, 60 decades to money that will be worth quite a lot in retirement. But because there's a very real risk that there's going to be additional and expensive reporting to the IRS for pensions, you can find that the small allowances that are allowed every year inside the pension get eaten up in taxes, at least for the first 3 or 4 or 5 years, which makes it very unappealing. You're sort of putting money away just to immediately spend it paying accountants. Nobody likes that. Nobody, even the accountants, enjoys that. And so you get these structures that are just everywhere you turn, it feels like the IRS is saying, or outright no. Whereas done properly here, the options that are going to be sitting in America are going to range from gray area to this could work really quite well if we do it properly. I mean, the structures that are available to a kid who's thinking about having outright ownership inside the US, you're going to be looking at potentially, for an old enough child, some form of IRA or Roth IRA, but there has to be earned income. So that makes it much more difficult to fund. So we don't see that too often.
Just taking a pause, I think we did do an entire episode on the taxation of IRAs, but just for those that are newer to the podcast, what actually is an IRA under the US code and how that differs from a pension? Because a lot of times people will use the term pension and they are thinking that they're covering an IRA, and we don't necessarily agree in the UK. So just at its most fundamental level, what is an IRA?
Sure. So it's an individual retirement account. And so while they're not pensions, pensions are set up in the UK under UK law. If you're very used to thinking in British terms, they're pretty similar to the concept of a personal pension. Very, very big differences, different allowances, different tax treaty, because you're underneath the IRS here. But it ultimately is going to be something you can set up yourself in your own name that benefits from tax deferral until retirement. So if you put money in, you get the tax benefits of income tax reduction in the year you put it in. It grows tax deferred. And then eventually when you take money out, it'll be taken out as income in retirement.
And this is where the US and the UK have expressly and specifically, as part of their double tax treaty, agreed that pension contributions, pension withdrawals, and the rolling up of pensions during their lifetime have a degree of fairly good reciprocity. Pensions is probably the one areas where the US and the UK are largely aligned. And yes, at the edges, there can be a little bit of a unique scenario where, okay, yes, the UK doesn't have an IRA, but it accepts it will treat them in this way, etc. And it can depend on whether you've got a traditional IRA or a Roth IRA or something. But yes, an IRA from the perspective of the UK, largely doable. Yes, there are particular things that you can do with an IRA, converting and rolling over and all of these things that, just need to be thought about carefully at each turn. But I wanted just to agree with you. If we're going to be putting our money into anything, I certainly don't mind IRAs as a fundamental account principle relative to, I think, some of the other things that we'll talk about in a little bit.
Yeah, that's right. But then just to highlight the downside, you do have to have earned income. And so there are child labor laws. It's going to be difficult to get earned income when you got a 2-year-old who's just coming onto the scene. So IRAs get difficult to fund because of that requirement. So if you do have someone who's very, very young and maybe an infant, and you're still thinking about larger contributions, that's not available. The pensions present their own problems, as we talked about, the small amounts and the potential complicated IRS filings. And so if you're looking at US-based solutions, it narrows it down now. So there are some tax advantage plans called 529 plans, which I'm not going to talk about now because I'm sure there are lots of questions to come. But that is a very viable option inside the US for someone who is looking only for US taxation to get ready for college costs. Very, very viable. It's set up, as you say, to incentivize something, which is getting ready for the incredibly high cost of university over 4 years in America. And then the other option that's out there amongst sort of the common ones we're going to see is going to be a UTMA. So it's a custodian brokerage account for someone under the age of 18. And that can make it so that effectively you're almost able to set this up like we would see for anyone over the age of 18, a brokerage account that the investments can be chosen intelligently so that they're going to be tax efficient in the US and in the UK. We can talk about how to align that towards goals and objectives and timeframes and time horizons. And that sense, it works quite simply. Now, we then sit down with someone very knowledgeable like Aidan Grant, and we say, let's make sure that any UTMA account is going to be okay with the treatment here at the HMRC, because I know you are quite right to raise the fact there are potential issues there with how the HMRC will interpret those accounts.
Yeah, I mean, before worrying about those, which I do want to, and I do worry about, just taking a step back in terms of explaining, one, can you tell me the difference between an UGMA and an UTMA, a UTMA and a UGMA? Because I hear this phrase bandied around fairly interchangeably. But two, from a US perspective, do you get any benefit from it beyond it merely being a managed custodian account? Compared to, say, a junior ISA in the UK where you actually get a tax-free roll-up, is it a tax-advantaged arrangement in the US, or is it just a structural account that has the benefit of being an account you can open for a minor? So your two questions, UTMA versus UGMA, and is there any US tax advantage to the UTMA-UGMA beyond just the practical advantage of being able to open an account for a minor?
Sure. So I'm no legal professor here. My understanding for UGMA and UTMA is that they're effectively the same concept here with very tiny differences. It's a Uniform Gift to Minors Act account as UGMA. Uniform Transfer to Minors Account Act account is the UTMA.
Let's use UTMA.
And
let's use UTMA and UTMA for the time being.
my understanding is that because these are uniform acts that were passed across all 50 states, the idea was to make everything the same. And the UTMA and UGMA went side by side before the UTMA became much more common. So you're right. I mean, nowadays you're going to find that almost every state has a UTMA, but I think that ultimately they're achieving the same thing, which is how to set up an account for someone who otherwise can't own something outright as a minor. And in terms of the benefits, you're right. Let's remind ourselves, this is where, to a certain extent, you are focusing less on the clever, interesting, cool benefits that are out there. You're passing up on tax-free ISAs in the UK. You're passing up on the issues with potentially being tax-free for 529 accounts. And you're saying, actually, what I want is simplicity. I want something that lets me invest for a minor that should hopefully be as customizable as possible to avoid tax problems. There are not going to be anything here offered by UTMA that shields you from tax issues per se. Really what you're trying to do is you're trying to say, whether you want to put in $100 or $100,000 or more, this is an account that you can easily set up, get invested, and have in the name of a minor.
And I was hoping you were going to say that because that was my understanding of what they were. The distinction I want to draw, because it is conceivable that you could compare, for example, an UTMA and a junior ISA. But a junior ISA is a form of brokerage account that you can open for a minor. And because it's an ISA, it has particular tax incentives to encourage people to invest through them. An UTMA is a brokerage account with a custodian on top that you can open for a minor, but it doesn't have the same incentivization, the same tax relief incentivization to encourage people to use them. They are an administrative tool rather than a tax planning tool.
That's right, exactly. And so actually, while we keep talking about the junior ISA, it's a very common thing to see. In some ways, what you're going to be seeing is the much more common or much more direct comparison here is to a general investment account in the UK, a GIA. And it's there that you realize, as we've realized, there is no way to just have a minor own a junior investment account in the UK. To set up a custodian relationship, you have to set up some form of actual bear trust to hold the assets in the UK. And that can work. And there are certainly valid reasons to discuss that. People often shy away from it because of the fact that you are now setting up a UK trust, and it's going to have to be reported somehow to the IRS every year. And that, for most people, is not going to sound like a simple or pleasant experience. And the UTMA becomes much, much more appealing after that.
Well, so you have the same issue in reverse. So the issue with setting up a kind of a nominee arrangement, a bear trust in the UK, is that you might have to report it in the US and report it as a foreign trust and all the tax reporting that goes with that. The flip side is, how does the UK view an UTMA? Because at its most fundamental level, you have assets being held for someone else. And assets being held for someone else means a trust. That is the fundamental definition of a trust. Now, in the UK scenario where we have what we call a bear trust gives no complicated UK tax results. The beneficiary of the bear trust is treated as almost all UK tax purposes the underlying owner of the assets. The person with the control of the assets is merely acting as a nominee, but the underlying control and tax consequences sit with the beneficiary. In the US, when we view these type of structures, the question is, this is like having a living trust argument with you, Patrick, which is my other favorite topic. When we view this particular structure in the US, there is clearly a trust relationship because the beneficial ownership and the legal ownership, the custodian ownership, are not in the same hands. And so we have a trust relationship. The question is the nature of that trust relationship one of a merely nominee level? Is it that, like the Americans think, like we think in the UK with the junior ISA, it is merely person A holding money as a nominee for person B? Or do we in the UK think that that UTMA is in fact an actual trust because there is someone holding money on behalf of that minor child as more than just a mere nominee? And it gets quite complicated. And there is not, as far as I'm aware, any express written UK statute, case law, tax code, practice guide that says this is how you treat UTMAs, how you treat UTMAs. I think it is the case that most lawyers will find themselves comfortable eventually in lots of cases that an UTMA is a bare trust. It is treated just as the minor's money. But that does depend on each individual UTMA and each state's local rules because as you pointed out, the UTMA applies in different states differently. And so that is why we as the lawyers are cautious when we see UTMAs on the portfolio, is because it's like, are we going to have to get into this discussion about does the UK reciprocate that US treatment? Do we have to give the bad news that actually this could be a lot more complicated, particularly if the money doesn't kick out and become the child's at 18. Maybe it kicks out and becomes the child's at a slightly higher age. That looks less like a bare trust in the UK because in the UK you inherit at the age of 18. What if that account then continues thereafter and then just becomes the child's general investment account? It starts to get a bit difficult. And so that's why we as lawyers sort of like to clutch our pearls and say, do we have to use them? Because it's complicated from a UK perspective. And I, as a lawyer, I have come to you, I will come to you again in the future and go, is there another alternative that is going to be easier? And you will rightly turn around to me and go, no. This is conveniently, administratively, and from a US tax perspective, the best I can do. You just need to get over your inconsistencies and your concerns in the UK, because if we don't use this account, we're into we're just adding different parts to the scales in terms of weighing up the positives and negatives.
Exactly. Nothing is going to be perfect here because we can't give outright ownership to someone. So we know that there's always going to be some issues around trust and ownership and everything. But yes, ultimately, I think you're right. It's about working together. You say you come to me, I come to you every bit as much and say, let's make sure everything's signed off on before we open it. But exactly, if we wanted to go the alternative and set it up in the UK, it tends to be, correct me if I'm wrong, you're the expert in trusts, but it tends to be that the IRS's interpretation of a foreign trust is harder to make work and more expensive to report than going through all the motions and saying this is a bare trust in a UTMA in the US. And at that point, it's relatively easy to maintain year in, year out.
What is, I think, certainly the case, and neither you or I are US tax advisors, so everyone should caveat their ears accordingly. If what we have in the US is, from the UK perspective, a bare trust, it's a nominee arrangement, the UK tax reporting is very simple. If the US sees what they consider a trust, whether a bare trust from a nominee arrangement or a substantive trust from their perspective, the reporting is complicated, in my experience, in either scenario. So even if we think of this thing in the UK as a bare trust arrangement, the US reporting is still going to be complicated. Whereas at least if it's a bare trust from our perspective in the US, our reporting is simple. So that's what I agree with you in that frame of reference. That's why the UK reporting with these US products tends to be slightly easier, because if we can find it to be a bare trust, if we can find it to be a nominee arrangement, then everyone breathes a big sigh of relief and goes, oh, fine, yeah, it's great, we can just crack on with it, as opposed to some poor tax advisor in the US having to now file a complex tax return saying, here is a foreign trust that's been created and here's all the reporting on it, which just starts to get complicated. What I would like to do with the remaining time, if I can, is to circle back to the other account that you said you were going to skip over because we were going to come to later, which is a 529 plan. Because a 529 plan is the other US account that has minors involved that we see very frequently. And I won't lie, they just get me very cross-eyed. I have always struggled to understand 529 plans. So could you first explain from a pure US basis what a 529 plan is and why it's different than an UTMA or just holding some money for your child until they reach college age? What does a 529 plan allow someone to do?
529 plans were brought in at the turn of the century in 2001. They were brought in to address the fact that it was getting more and more expensive to send people to university in the States, but public policy, again, would be that's a good idea. Educating people is seen as something to encourage. And so they passed legislation that said under Section 529 of the IRS Code, there is the ability to set up an account that lets you put in quite a lot of money each year that then will grow tax deferred for as long as you leave it in there. And if you then spend that money on qualified educational expenses like tuition and board and books and all the things you'd expect for a university, and now to a certain extent, secondary private education, that money can be withdrawn, not tax deferred, but tax free. You can take all that money and never pay any of the catch up taxes and all the capital gains and income that was happening for the decade plus that it was inside of there. And it's very appealing because you can put in quite a lot of money each year. Family members can make gifts in directly to it themselves. And you can end up with these very, very large accounts that really can cover the six figures cost of education in the US. The tax advantages are huge. If set up properly, you're going to be able to benefit from not having to pay any taxes on that large pot of money.
Just to be clear to make sure I've understood, if I do spend the money that's in the 529 plan as a parent or in collaboration with my child on the things that qualify as permitted expenditure, no one at any point pays money on the income and gains as they roll up inside the account or on any kind of withdrawal. So it's kind of a tax deferred account, but also an account that has no tax on the withdrawal either, or the expenditure from within the account.
That's right. As long as it's used for education, it's better to think of it as a tax-free account under the IRS rules. Exactly right. And so the appeal is substantial. You can see why people very, very much like using them.
Am I right? Because I hear this a lot, and I've certainly never delved into the qualifying criteria for this, but I hear these things on the grapevine. Is it right that there are some UK institutions, some UK higher education institutions that fall within the qualifying expenditure requirements for 529 plans? So from a US tax perspective, if your child doesn't go to Harvard or Yale or Columbia, but goes to Oxford or Cambridge, from the IRS's perspective, it might still be the case that they still give you that permitted deduction because certain UK universities qualify.
That's right. So it just has to be an accredited institution with the US. And many of the universities here in the UK are. And, from personal experience, you can picture a much younger version of myself here. I had that exact same experience as a 17-year-old from the States coming over to university over here, and it was an accredited institution, so was able to use US funds like that to get normal US tax treatment.
You can think 5 years back, Patrick, that far away?
All right now. I think anyone who's watching this can see that is not the case. No, it's the case that spending, it's not hard. And you and I have to be careful here because there's the tax treatment questions that we're going to be talking about. But the issue is, let's keep digging on the 529 plan. So the 529 plan, now that we're thinking of it not as US only people, but as UK, US dual qualified people who are talking about the real issues that our clients face, it matters that 529 plans are set up by each state and the District of Columbia as a trust held with that state. So although it is a 529 plan and people think they have their own account, what they really have is a sub-account inside of a state-run trust. And if you are not a UK taxpayer, it doesn't matter. Nobody really cares if you're living in, just going to pick on Kansas, but like Kansas, you're going to the University of Kansas and you're spending your money from the 529 plan. That's fine. That's all very clearly spelled out in the tax code. What isn't clear is how the HMRC is going to treat the fact that maybe someone who is born and raised in the UK as a dual citizen, what's going to happen if they have $200,000 sitting in a 529 plan in the US, and now their plan is to spend that on educational costs?
You have to go back even before there, because inevitably, we come back to the same dichotomy that we've been talking about over the course of this entire episode, which is this money the child's? Is this money the child's in their own name, or is this money that's being held for a child in some kind of trust arrangement? And if it's a trust arrangement, is it being held on a nominee basis, or is it being held on a substantive basis? Because while this money is growing, unless there is a specific provision that says we don't tax something, it is income or is a gain arising to someone. So someone somewhere is paying tax. It is the case that if it is a trust from a UK perspective, and that trust is foreign to the UK, it might be that no one in the UK is taking any tax because it's a foreign trust, and as a really general rule, you don't pay UK tax in a foreign trust on sources of income and gains outside the UK. But if that child is in the UK and receives a benefit in the UK, like, for example, I don't know, going to university and 200 grand is dumped out of the account while that child is a UK resident, well, you've now just received a distribution from an offshore trust. And so it's not just about what happens at the end. It's also who, if anyone, should have been or is paying tax as the arrangement goes along. And so the answer to this question is going to depend upon who is the custodian of the account. Is the custodian of this account the parent of the child? Is the parent themselves UK resident? Is the custodian of this account the grandparents? Have the grandparents set up the 5 to 9 plan? The grandparents living back in Kansas in your scenario. That can affect how the UK views the tax status of this structure before we then start thinking about, well, when is the UK tax going to apply, etc. This is why, again, whenever I see a 529 plan on a fact sheet, I'm always saying, I know eventually people seem to make this work, and it's not like we throw our hands up and go, good God, immediately dump everything out of your 529 plan. But I always get nervous about them being there because of just the risk of the UK treating them differently.
I feel the exact same way. You want to come in these discussions with definitive answers and solutions. And 5 to 9 plans effectively force all of our hands as practitioners and say, we will walk you through chapter and verse on how this works and how this is structured and what the issues are. But ultimately, this is a very big gray area in the tax code. Ultimately, 5 to 9 plans haven't been particularly tested. And because this is often being held in Kansas or somewhere else in the States, and the benefit is flowing to the university directly, and this is going to be reported on a 18-year-old or 19-year-old's tax return, it is the sort of thing that does sort of fly under the radar quite often. Not on our advice, but because it's not being tested by HMRC very often. It doesn't get picked up very often. I think everyone would love to have some definitive answers here on HMRC about how it's going to be taxed. But instead, we come to clients and we say, because there is no structure here that says a 5 to 9 plan in the eyes of the HMRC, we're looking for the nearest thing that we can compare it to. It seems like a trust. There could be some issues, but in reality, a lot of people end up having them that were set up by grandparents, and they do tend to get used at some point. And then it falls down to the accountant to say, how is that going to be treated in terms of the distribution? But what I would probably say from a planning perspective is it's not a great idea to set up a new one as a UK resident and start superfunding it for your UK resident US citizen child. That is not something that we're ever going to recommend. We can work around it when somebody comes with one and say, here are the issues, here's the gray area, here's how much risk you might be exposed to. Please consult with your accountants and let's make a plan in the years we have to come. But should I open a new one? No, I think we should pump the brakes there and say, don't start a problem here when you haven't made one yet.
It can get complicated because you're sometimes reassuring or trying to tell clients that the consequence can be based on a variable. That variable sometimes inside their control, sometimes not inside their control. For example, if we have a 5 to 9 plan set up by a grandparent, and the grandparents are the custodians on the account, and the child is a UK resident but ends up going to university in America, even if we look at this trust arrangement in its most negative form, if the child isn't in the UK by the time they come to benefiting from the structure, then under our UK offshore tax rules, there's no tax consequence when the person outside the UK receives a benefit. So you think, oh, great, because if the child doesn't go to university in the UK, maybe a grandparent's 529 plan works great. And then I say to the clients, well, except the UK has anti-avoidance rules that says if the child comes back to the UK within 5 years of having left the UK is going to claw back the money it would have received had the child been a UK resident. We call those the temporary non-residency rules. And then we say, well, a US undergraduate course is 4 years long, but that's 4 years starting in September. The UK tax year starts in April. The US tax year starts in January. So will they have been out for 5 years? Probably not. Will your child go on and do a master's degree? Or will they go to law school or do a PhD? Maybe they will, maybe they won't. No one knows. And so you can say to a client, here is a scenario where this actually might be absolutely fine, but you've kind of got to hit every single green light as you're speeding through the town to get out of it scot-free. If any one of these lights turns red, you're stuck.
Yeah. And then you talk about a few other fundamental things too, right? In terms of, sure, that you might go get a master's degree, a PhD or whatever, but did you spend all that money in the 5 to 9 plan of the first year? Or actually did you spend it over the 4 years or the 5 years or 6 years of postgraduate work as well? In which case, it's going to be a long time until you get out of that 5-year tail for any avoidance. There's also the question about residency as well, right? So someone might go to university in America, but they're coming back at Christmas and Easter and all summer and working over here. Have they broken tax residency? That's another question. So that perfect scenario here exists, but when you're looking at a 4-year-old and you're saying, are you going to do all this? Most people would throw their hands up and say, I'm not going to commit to that now. I'm not going to set a narrow canyon that they have to go down to use this account. I would much rather have it be flexible. I'd much rather say, if they end up going to university here in the UK, that's okay. I don't want to push them away and send them off to a foreign country where I'm not going to be a resident. Yes, you're passing on the US tax benefits of the 5 to 9 plan, but you're keeping so many more doors open that looking at something like a UTMA gets much, much more appealing because those funds can still be in the name of the child and ring fence for their future, but with a whole lot more flexibility.
To reiterate what I said back earlier in this episode, this is one of those examples where you may be opting to take the more convenient but slightly longer route to get to your end destination on your sat-nav, rather than telling your sat-nav, I want to get there fastest. You might get there faster, technically speaking, but you're going to hit a lot more metaphorical or literal bumps along the road as you get there. So it's why your industry, Patrick and Tanager, and you personally are so good at this, because you have to really help our client lay out precisely what are their objectives, what are they prepared to concede, what are their absolute red lines that they're not prepared to concede. And if the answer is they want maximum tax efficiency and they're prepared to tie themselves in knots to get there, then fine. But a lot of clients in these scenarios might well just say, the UTMA's good. I make my life complicated enough as a US UK person. Let's not make it any more complicated by trying to set a new 529 plan up. God forbid.
Yeah, I think that's exactly right. And that's where there's options. And that's why we walk through these various courses.
Do you think that parents of young US children have been sufficiently scared into thinking they can only ever hide cash under their mattress or invest in gold bars buried in their garden? Are you going to be flooded by a series of parents thinking those are my only options?
I hope not. I mean, that's hopefully not at all what we're trying to get across here, that there are at least a few solutions here that are really quite clearly going to be workable. Yes, you might need to get a couple bits of advice in place at the beginning here to make sure it's structured exactly the way that everyone in their tax world was happy with. But ultimately here, we can be setting up accounts in the adult's name for the ultimate benefit of the children when they turn 18 or when they're ready for it. We can set up accounts in the child's name that should be relatively straightforward to administer and tax efficient in both jurisdictions. So definitely don't feel that the only solution here is strange burial vaults in your backyard or something like that. That's not what we're recommending whatsoever. It's more just, this is going to be part of a wider financial plan. And there's a couple very good solutions.
But start at the beginning. Don't stick your head in the sand thinking, I'll get to that later. Start early, plan early, speak to an advisor early, because you'll be set out on the best route possible then.
And the trouble is, I'm asking you to do that when you're probably already pretty frazzled. You're probably already dealing with 2 hours of sleep a night, grandparents who are the best in the world, best intentions, trying to help you out here with finances. And it's a very hard time of life to say, in addition to everything else in my life, I need to take at least a few hours to get some basic advice about the right structure for our family. So I appreciate that's difficult, but it does repay itself by a long, long time of having compounding returns that are going to be set up with the least amount of hassle for years and years and years to come.
Amen. So the question is, for those people who are looking to take that advice immediately or looking to take the advice having listened to this podcast, Patrick, where can people find you? How can they get in contact with you?
We're always happy to talk to any American that's going through this. There's a lot of personal connection as well. As someone who's married to a Brit and dealing with dual citizen children myself, I'm always happy to have a conversation, as is everyone else at Tanager. So you can find us at tanagerwealth.com. My email is patrick@tanagerwealth.com. Always happy to talk and just see what the scope of potential options here for people that are thinking about doing this.
Wonderful. Patrick, thank you so much for your time. We will have to have you back on. I promise it won't be 4 years until the next time we have you back on.
Well, every time here is a pleasure. So thanks for having me on. It's great to see you. And thank you so much for all the questions today.
Wonderful. Thank you very much. Thank you for joining us again on the US UK Tax Talk podcast. And a particular thank you to Patrick Mulhern of Tanager Wealth Management for coming on for his second go on this series. A reminder that we're now releasing episodes on a monthly basis on the first Wednesday of each month. So make sure that you like and subscribe and you won't miss an episode. Make sure you also check out Colin Bristow's YouTube page, where you can find all of our most recent episodes in video format. Until next time, we'll see you then.